Before we dive in, please remember that this presentation is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent. The information provided here is not a substitute for professional advice. You should always consult with a qualified professional before making any financial decisions. Your own situation is unique, and the insurance landscape varies significantly by state and individual circumstances. Mark considered himself a responsible guy. He paid his bills on time, had a good driving record, and for 12 solid years, he'd been with the same auto insurance company. Let's call them All Good Insurance. Every 6 months, like clockwork, the renewal notice would arrive in the mail. The price would tick up a little, $10 here, $15 there. He'd let out a sigh, think to himself, well, inflation, I guess, and he'd write the check. He trusted them. He felt loyal. And he made the critical assumption that his loyalty was being rewarded. In his mind, he was a long-term valuable customer, so they must be giving him their best possible rate. That single assumption, that feeling of loyalty, ended up costing him over $7,000. How many of you feel just like Mark? You see the commercials with the friendly talking lizards and the goofy emus, the ones with the catchy jingles that promise you're in good hands, or that they're on your side, or that you can name your own price. You've been with your company for 5, 10, maybe even 15 years. You haven't had an accident since high school. You've never even filed a major claim. And yet, every single year, that premium just keeps creeping up, doesn't it? Feels like a tax on breathing. A penalty for just owning the car you need to get to work. And the worst part? The thought of actually switching feels exhausting. Feels like a monumental task you just don't have time for. You imagine spending an entire Saturday chained to your computer, typing your name, your address, your date of birth, your VIN number, into 20 different websites, answering the same invasive questions over and over again. How many miles do you drive to work? Is your car garaged? Have you had any speeding tickets in the last 3 years? And you know what comes next. Your phone starts blowing up with calls from numbers you don't recognize, and your email inbox gets flooded with a tidal wave of spam for the next 6 months. It's a nightmare. And it's deliberately confusing. What is the deductible, really? What's the functional difference between comprehensive and collision coverage? Do I actually need uninsured motorist protection if I live in a good neighborhood? The entire industry is built on a foundation of complexity and inertia. The insurance giants are counting on you to think, it's just too much hassle. I'll just pay the bill and stick with what I know. And that, right there, is the single most expensive financial mistake millions of Americans make every single year. Well, today that ends. Over the course of this series, we are going to pull back the curtain and expose the inner workings of the auto insurance industry. I'm going to give you a complete step-by-step playbook for finding the absolute best coverage at the lowest possible price, right in your own neighborhood. We're not just talking about saving $50 a year. We're talking about a strategy that could put hundreds, or in many cases over $1,000 back in your pocket annually. And in this first part alone, we are going to dismantle the single biggest lie in the insurance world, the myth of the loyalty discount. I'm going to show you exactly why your loyalty is likely being systematically punished, not rewarded, and I'll give you the first most critical step you need to take tonight to start taking back control of your money. So let's get back to Mark and his $7,000 mistake. What he fell victim to is a quiet, insidious practice that industry insiders call the loyalty penalty, or a more sanitized term, price optimization. It sounds complex, but it's brutally simple. Insurance companies are data machines. They use incredibly sophisticated software to analyze every aspect of your behavior as a customer. They know how long you've been with them. They know if you've called to complain about a rate hike. They can even track if you've been getting quotes from their competitors. And their mountains of data have shown them something fascinating, and frankly a little depressing. The longer a customer stays with them, the less likely they are to leave, even when their rates are repeatedly increased. They have calculated your price elasticity. They figured out your personal pain point, the maximum price increase you will tolerate before you finally get fed up and go through the hassle of shopping for a new policy. So what do? They raise your rate right up to that line. Slowly, methodically. $10 this term, $20 the next. You don't notice the big jump. You just feel the slow, painful creep. Meanwhile, what are they doing with their billion-dollar advertising budgets? They're dangling massive, lowball introductory rates to attract new customers. The very people they're trying to steal away from their competitors. So you, the loyal, stable, long-term customer, are literally subsidizing the discount that your neighbor just got for switching to your company. Let me say that again because it's critical. You are paying more so they can charge a new customer less. It is a business model that actively punishes loyalty. And don't just take my word for it. This isn't a conspiracy theory. A recent study by NerdWallet found that loyal customers could be overpaying by an average of over $400 per year. A deep dive investigation by Consumer Reports found similar results, with some long-term policyholders paying more than double what a brand new customer would pay for the exact same coverage. Imagine that. Paying double. Your reward for being a good, stable customer for a decade is a bill that's twice as high. The system is designed from the ground up to take advantage of your trust, your comfort, and your busy life. They know you have kids to pick up from soccer practice, a demanding job, and a life to live. They are betting that you won't take the time to check. And for 12 years in Mark's case, they were right. So what's the first step to breaking this vicious cycle? It's a simple but profound mindset shift. You have to stop thinking of your car insurance as a long-term relationship. It is not a marriage. It is not a friendship. It is a purely transactional business contract that you should reevaluate on a regular basis. I want you to do something right now. Pull out your phone and open your calendar. I want you to schedule an event. Call it your annual insurance checkup. Set it for 1 month before your current policy is set to renew. Make it a recurring event. This is your non-negotiable annual appointment with your own finances. During this checkup, your one and only goal is to find out what you're really paying versus what you could be paying. This single habit is the foundation of everything we're going to build on in this series. It's the simple move that takes you from being a passive bill payer to an active, empowered consumer. Now you might be thinking, okay, I get it. I need to shop around, but where do I even start? Do I just Google cheap car insurance near me and click on the first 5 paid ads? That's what most people do, and it's a recipe for frustration and spam calls. It's also why the near you part of this is so important. Because there's a world of difference between a faceless national call center 1,000 miles away and a local independent agent who understands the specific risks and regulations in your state, your county, even your zip code. They know which companies have the best reputation for actually paying out claims in your area, not just which one has the slickest Super Bowl commercial. A local agent understands that your part of Texas is prone to hailstorms, or that your corner of Florida has higher flood risks. That local knowledge is a secret weapon, and we're going to dive deep into how to leverage it later in this series. But that journey starts with getting a crystal clear picture of your current situation. So your first piece of homework is to schedule that checkup. Your second piece of homework is to find a single document. It's probably sitting in a dusty file folder, or maybe it's a PDF buried in your email inbox from 6 months ago. It's called your declarations page. This one-page document is the Rosetta Stone of your auto insurance. It is the key that unlocks everything. It tells you exactly what you're paying for, what your limits of liability are, and where the hidden opportunities for massive savings are buried. Most people have never actually read it, let alone understood it. In the next part, I'm going to show you how to read your declarations page like a seasoned pro. We're going to break it down line by line so you can walk into any negotiation, whether it's with your current company or a new one, armed with the most powerful weapon of all, knowledge. You'll learn the 3 specific numbers on that page that are most likely costing you a fortune, and I'll tell you exactly what to do about them. Don't let yourself be Mark. Don't wait 12 years and $7,000 to find out you've been overpaying. Let's start the fight to get your money back right now. The first and most devastating mistake millions of Americans make is something the industry calls the loyalty tax. It sounds almost friendly, doesn't it? Like a reward. But it's the opposite. It is a penalty for being a good, stable customer. It's a punishment for your trust. Think about Sarah. She got her first car insurance policy with a big, national brand when she was 17. Her parents used them, so she did too. For 20 years, she never missed a payment. She had one minor fender bender in college, but otherwise a perfect record. Every 6 months, her renewal notice would arrive. The price might go up by $3 a month. The next year, maybe $5. It was never enough to cause alarm. It was like boiling a frog, the temperature rising so slowly she never felt the need to jump out of the pot. She assumed her loyalty was being rewarded with the best possible rate. Why would they charge a 20-year customer more than a brand new one? Just doesn't make sense. But it makes perfect sense to the insurance company's algorithm. This practice is also known as price optimization, and it's one of the most cynical, predatory tools in their arsenal. The algorithm sees that Sarah has been a customer for 20 years. It sees she hasn't shopped for a new quote since the last time a flip phone was cool. And it makes a bet. It bets that Sarah is comfortable, that she's busy with her job, her kids, her life. It bets that the hassle of searching for new insurance, of filling out forms and making phone calls, is more painful to her than an extra $5, $10, or eventually $50 a month. And so year after year it nudges her premium up. Not because she's a riskier driver, not because her car is more expensive to insure, but simply because it can. Because she has shown through her inaction that she is willing to pay it. The industry has a term for customers like this. They call them sleepers. They are banking on you being asleep at the wheel of your own finances. That $7,000 my friend Mark overpaid? The vast majority of it was a loyalty tax. The single most powerful thing you can do to fight back is to prove their algorithm wrong. You have to shop around. Not every 5 years. Not every 10 years. You need to shop your policy at every single renewal. Every 6 months. 1 year at the absolute most. Think of it like a job performance review, but you're the boss and the insurance company is the employee. And every 6 months you're telling them, show me why you still deserve my business. Show me you can beat the competition. Because I promise you right now, another company is desperate for your business and is willing to give you a massive new customer discount just to get you to switch. By staying put, you are leaving that money on the table and giving it to a company that is actively penalizing you for your trust. The second mistake is a psychological trap, and it's built around a single number: your deductible. This is the amount of money you have to pay out of pocket before your insurance kicks in to cover the rest. Most people, when they sign up, are driven by fear. Fear of a big unexpected bill. So they choose the lowest possible deductible. $250. $500. Feels safer. It feels like you're more covered. But that feeling of safety is costing you a fortune. Let's look at Tom. Tom is a cautious guy. He chose a $500 deductible on his collision coverage because the thought of having to pay $1,000 or $1,500 after an accident terrified him. But to get that low deductible, his monthly premium is $40 higher than it would be with a $1,000 deductible. $40 a month doesn't sound like a lot, but let's do the math. $40 a month is $480 a year. Every single year, Tom is paying nearly $500 extra to avoid the possibility of having to pay an extra $500. Think about that. In just over a year, he has already paid the entire difference of the deductible and higher premiums. If Tom goes 2 years without an at-fault accident, he has paid an extra $960 to his insurance company. He could have just put that money in a savings account. After 2 years, he would have had almost $1,000 ready to go, enough to cover the higher deductible, and he would have pocketed the extra cash. If he goes 5 years without a claim, he has lit nearly $2,500 on fire, handing it over to his insurer for peace of mind he could have given himself for free. The insurance company loves when you choose a low deductible. They are taking your understandable fear and monetizing it. The solution is to raise your deductible to a level you can comfortably afford to pay from an emergency fund. Raise it from $500 to $1,000. Maybe even $1,500 if you have the savings. The premium savings are often dramatic. And what do you do with those savings? You use them to build the very emergency fund that will cover the higher deductible if you ever need it. You are self-insuring for the small stuff, which is what wealthy people do, and only using the insurance company for a true catastrophe, which is what insurance was originally for. You are betting on yourself. You are betting that you will be the safe driver you are 99.9% of the time, instead of paying a massive premium based on the 0.1% chance you'll have a bad day. The third mistake is one born from $100 billion of advertising. When you think of car insurance, what names pop into your head? The big ones, right? The ones with the talking animals, the catchy jingles, the celebrity spokespeople. We are so bombarded with their marketing that we instinctively believe they must be the biggest and therefore the best and the cheapest. We assume that a company that can afford a Super Bowl ad must have the most competitive rates. This is a catastrophic assumption. In fact, it's often the exact opposite. Who do you think is paying for those billion-dollar ad campaigns? You are. It's baked right into your premium. Many of the best deals on auto insurance are hiding in plain sight, with smaller, regional and local insurance companies you've never ever heard of. Think about it. A company that only operates in, say, the Midwest, doesn't need to advertise in California or New York. Their overhead is dramatically lower. More importantly, their understanding of risk is more precise. A national company has to create a pricing model that works for the traffic chaos of downtown Los Angeles, the icy backroads of rural Maine, and the hurricane-prone coasts of Florida. A regional company that only insures drivers in Texas and Oklahoma can focus exclusively on the risks relevant to that area. Hailstorms, long highway commutes, that sort of thing. Their data is more specific, so their pricing can be more accurate and often much lower. I once saved a friend over $800 a year by switching him from a massive national brand he'd been with for a decade to a company that only served our state. He'd never heard of them. He was skeptical. But their rates were incredible, and when he later had a claim, their customer service was phenomenal because their reputation in the local community was all they had. They couldn't hide behind a cartoon mascot. So how do you find these hidden gems? You have to become an active searcher. Go beyond just calling the 1-800 numbers you see on TV. Use a search engine and look for top-rated auto insurers in your state or independent insurance agents near me. An independent agent is your secret weapon. Unlike a captive agent who only works for one big company, an independent agent works with dozens of different carriers, including these smaller, regional players. They do the shopping for you for free. Their job is to find you the best coverage for the best price, regardless of the company name. You are outsourcing the fight. You are using an expert to uncover the deals the big guys spend billions of dollars to keep you from seeing. We've just plugged 3 of the biggest leaks that are draining your bank account. By committing to shop every renewal, raising your deductible to a sensible level, and looking beyond the big national brands, you have already put yourself ahead of 90% of drivers on the road. You've taken back control. But the next mistake is far more subtle. It's a psychological trap, a single question on the insurance application designed to trick you into paying more. And it works on millions of savvy people. It has to do with how you describe your job, and the box you check could be costing you hundreds of dollars. I'm going to show you exactly what it is, and how to answer it to put that money back in your pocket. So what is this magic box? It's the occupation field on your insurance application. And I know what you're thinking. My job? What does that have to do with my driving? The answer is everything. To an insurance company, your job title isn't just a piece of demographic data. It's a powerful and surprisingly accurate predictor of your risk. When you type in your profession, you think you're just telling them what you do for a living. But you're wrong. You're actually telling them who you are in the eyes of their complex, data-driven risk algorithm. You're giving them a shortcut to judge your lifestyle, your habits, your stress levels, and even how likely you are to be driving late at night. Let's peel back the curtain on this. Insurance companies are, at their core, data companies. They have been collecting information for over a century. They have mountains of data, we're talking billions of data points that correlate professions with claims. They know statistically that certain jobs are associated with more accidents. It's not personal, it's just math. They've crunched the numbers and found that, for example, people in high-stress jobs who work long, unpredictable hours tend to file more claims. Think about doctors, journalists, or chefs. They might be more fatigued, more distracted, or more likely to be rushing. On the other hand, jobs that are perceived as more stable, analytical, and routine, like a librarian, a scientist, or an accountant, statistically have fewer claims. These professions are seen as lower risk, and therefore they get lower premiums. The mistake millions of us make is being too literal and too modest. We don't think strategically about how we describe what we do. Let's say you're a freelance writer. You might just type writer into the box. To an insurance underwriter's algorithm, writer can conjure up images of a starving artist, unstable income, tight deadlines, and lots of late nights fueled by caffeine. It screams risk. But what if you're a writer who specializes in technical manuals for software companies? You could truthfully describe your job as technical author or even project manager. These titles sound more stable, more corporate, and less risky. The algorithm sees those words and breathes a sigh of relief. The result? Your quote could be 10 to 15% lower. Same person, same driving record, different label. This is not about lying. Let me be crystal clear. You should never lie on an insurance application. That's fraud, and it can get your policy canceled or a claim denied when you need it most. This is about being smart with the truth. Most of us wear multiple hats at our jobs. The key is to choose the hat that presents you in the most favorable, lowest risk light, while still being completely accurate. Let me give you a concrete example. Imagine a guy named Kevin. Kevin is a chef at a popular downtown restaurant. He works long, grueling hours, often getting out after midnight. When he gets quotes for car insurance, he puts down chef. His quotes are consistently high. The insurance company's data tells them that chefs work late, are often tired, and are on the road when more accidents, especially DUIs, happen. It's a high-risk category. Now, Kevin is also responsible for managing the kitchen staff, ordering all the food and supplies, and handling the budget for the entire kitchen. He's not just cooking. He's running a complex operation. So, on his next round of quotes, instead of putting chef, he tries a few other options that are just as true. He tries kitchen manager. The quote drops by $80 a year. Then he tries restaurant manager. The quote drops by another $50. Finally, he tries hospitality professional. Bingo! That title is broad, sounds stable, and carries none of the high-risk baggage of chef. His annual premium is now $200 cheaper than his original quote. He didn't lie. He's still the same person driving the same car with the same skills. He just chose the most advantageous and still accurate description of his profession. So how do you do this for yourself? First, get a piece of paper and brainstorm every single thing you do at your job. Think about your responsibilities, not just your official title on your business card. Are you a salesperson who is on the road all day? Or are you a marketing executive who develops client relationships from an office? Are you a construction worker, which implies physical labor and driving a big truck? Or are you a project supervisor who oversees job sites? Are you a bartender? Or are you a mixologist, or even a hospitality manager? One sounds like a risky late-night gig. The other sounds like a skilled, stable profession. Once you have a list of potential titles and responsibilities, go to the insurance quote website. Don't just type in your first idea. Use their drop-down menu as a research tool. Start typing a keyword related to your field like manage or tech or creative, and see what options pop up. You might find a title you hadn't even considered that perfectly and truthfully describes a part of your job. Play around with it. See how different but still accurate titles affect your quote in real time. Here are some general rules of thumb. Titles with the word manager, director, executive, or analyst often result in lower premiums because they suggest office work, stability, and a lower risk profile. Titles that suggest you're on the road a lot, like salesman, courier, or driver, will almost always be higher. Creative fields can be tricky. Artist or musician can be seen as high risk due to perceived income instability and late hours. But titles like graphic designer or illustrator often fare much better. If you're retired, don't just put unemployed. That's a red flag for insurers. Select retired. It shows financial stability and suggests you're probably not driving during hectic rush hours. If you're a student, be specific. A medical student often gets a better rate than just a generic student, because the profession they are entering is seen as stable and responsible. The difference can be staggering. We're not talking about saving a few pennies here. For many people, simply reframing their occupation from a high-risk perception to a low-risk one can save them anywhere from $50 to $300 a year. Every single year. That's thousands of dollars over the lifetime of your driving career, all for spending 10 extra minutes thinking strategically about a single box on a form. The system is built on generalizations and statistics. You can't change the system, but you can learn the rules and make them work for you. Be honest, but be smart. Choose the title that reflects the most stable, responsible, and accurate version of what you do. You've now learned how to frame your profession to save a serious amount of cash. It's a powerful piece of inside knowledge that most people will never know. But what if I told you there's another, even more significant factor that is secretly inflating your insurance premium, and it has almost nothing to do with your car or how you drive? It's a single 3-digit number that follows you everywhere, and insurance companies are using it to judge you more harshly than you can possibly imagine. Most people think there's nothing they can do about it, but they're dead wrong. I'm going to show you what this number is, why it matters so much, and the simple steps you can take starting today to fix it and unlock the biggest insurance discounts of all. That number, the one that can secretly double or even triple your insurance premium, is not your driving record. It's not the make and model of your car. It's something called your credit-based insurance score. And if you've never heard of it, you're not alone. Insurance companies don't exactly advertise it on billboards. They'd much rather you believe your rate is based only on how safely you drive. But the hard truth is, in almost every state, your financial history is one of the biggest, if not the biggest, factor in what you pay for car insurance. Now, before you get angry and say, "What does my credit card balance have to do with me running a red light?" Hear me out. Because understanding their logic is the key to beating them at their own game. Decades ago, insurance companies spent billions of dollars on statistical analysis, and they found a shocking correlation. They discovered that, on average, people with lower credit scores tended to file more claims. More frequent claims, more expensive claims, and even a higher likelihood of insurance fraud. Now, is this fair? That's a huge debate. It doesn't mean if you have a low score you're a bad driver. Of course not. It's a correlation, not a certainty. But to an insurance company, you're not a person, you're a statistic. You're a risk profile. And their data tells them that a person with a 580 credit score is, statistically speaking, a much bigger financial risk than a person with a 780 credit score. So, they charge the person with the lower score more money to cover that perceived risk. It's that simple, and it's that brutal. The practice is so controversial that a few states like California, Hawaii, and Massachusetts have banned or severely restricted it. But for the other 47 states, it's fair game. This means that you could be the safest driver in the world, no accidents, no tickets, a perfect record. But if your credit took a hit because of a medical bill, a job loss, or a divorce, your insurance rates could go through the roof and you'd have no idea why. You just assume that's the price of insurance in your area. But here's the good news. This isn't a life sentence. Unlike your age or your driving history from 5 years ago, this is a number you have incredible power to change. And when you change it, the savings aren't just a few bucks a month. We're talking about discounts of 20, 30, even 50% or more. It is the single most powerful lever you can pull to slash your insurance costs. So let's pull it. Right now, I'm going to give you a simple 3-step action plan to seize control of this number and turn it into your personal discount machine. Step 1 is the easiest, but it's the one most people never do. You need to see the data the insurance companies are using against you. You need to get your credit reports, not from some sketchy website that promises you a free score and then asks for your credit card. You need to go to the one official federally authorized source, annualcreditreport.com. Let me repeat that, annualcreditreport.com. By law, you are entitled to a free report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, every single week. You don't need to give them a credit card. It is completely 100% free. This is your raw data. This is the blueprint of your financial life that insurers are feeding into their secret algorithms. Step 2, become a detective. You are going to audit these reports with a fine-tooth comb. You are looking for errors. And trust me, they are more common than you think. A study by the Federal Trade Commission found that 1 in 5 consumers had an error on at least one of their credit reports. 1 in 5. That's insane. This could be anything from a late payment you know you made on time, to an account that doesn't even belong to you, maybe from someone with a similar name. It could be a credit card you closed years ago that's still showing as open with a balance. Each one of these errors is a little anchor, dragging your score down and driving your insurance rates up. A single incorrectly reported late payment can drop your score by 60 to 100 points. That one little mistake, a clerical error made by a bank employee hundreds of miles away, could be costing you hundreds of dollars a year in extra insurance premiums. You need to find these errors and you need to eliminate them. Which brings us to step 3. Dispute every single error. This sounds intimidating, but it's not. The credit bureaus have made it incredibly easy to do this online. You go to their websites, Equifax.com, Experian.com, TransUnion.com, you create an account, pull up your report, and right next to the inaccurate item, there will be a button that says Dispute. You click it. You state very simply, "This is not my account," or "I was not late on this payment," and you provide any proof you have. By law, the credit bureau then has 30 days to investigate your claim with the company that reported the information. And here's the kicker. If that company can't prove the information is correct, or if they just don't respond in time, the credit bureau must remove the negative item from your report permanently. I've seen people's scores jump 50, 80, even over 100 points in a single month just by cleaning up a few old inaccurate items. That is a life-changing difference, not just for your car insurance, but for your entire financial future. Now, cleaning up errors is the immediate fix, but the real power comes from building a strong credit profile over time. And it all boils down to just 2 main things. Forget all the complicated advice you've heard. Just focus on these 2. First, pay every single bill on time every time. Your payment history is the single biggest factor in your credit score, making up 35% of it. One late payment can stay on your report for 7 years. The easiest way to crush this is to automate everything. Set up automatic payments for at least the minimum amount due on all your bills, credit cards, car loans, student loans, everything. You can always pay more manually later, but this ensures you will never, ever be late by accident. It's a simple system that makes you look incredibly reliable to lenders and, yes, to insurance companies. Second, keep your credit card balances low. This is the second most important factor, and it's called your credit utilization ratio. It's a fancy term for a simple idea. What percentage of your available credit are you using? If you have one credit card with a $10,000 limit and you have a $9,000 balance on it, you're using 90% of your credit. That's a massive red flag. It signals financial distress. It tells the algorithm you might be overextended and therefore a higher risk. The golden rule is to keep your utilization below 30% on every card. So on that $10,000 limit card, you never want the balance on your statement to be more than $3,000. But if you want to get into the elite tier, the 800+ credit score club, you keep it under 10%. That means a balance of less than $1,000. This one change alone, paying down your balances before the statement date to get that utilization number down, can have a faster and more dramatic impact on your score than almost anything else. That's it. Get your free reports, dispute the errors, automate your payments so you're never late, and keep your credit card balances low. It's not rocket science, but it is the secret key that unlocks the door to the absolute best insurance rates. By focusing on this, you're not just playing defense anymore, you're playing offense. You are actively changing the data that insurance companies use to judge you. You are rewriting your own story, forcing them to see you as the low-risk, responsible person you are. And they have no choice but to reward you with the discounts you deserve. We've just fixed the financial you. We've cleaned up your profile on paper to make you look like the perfect customer. But what about the actual you? The you behind the wheel? In the next part, we're going to dive into the technology that is changing the insurance game forever. I'm talking about the little devices and smartphone apps that watch how you drive, how you brake, how you accelerate, what time of day you're on the road. They call it telematics, and insurance companies are pushing it hard. They promise massive discounts if you just let them monitor you. But is it a golden ticket to savings, or a Trojan horse that gives them all the ammunition they need to raise your rates? The truth is, it's both. And I'm going to show you exactly how to use their own surveillance technology against them to lock in the deepest discounts they offer, without falling into their traps. So let's talk about their surveillance technology. It goes by friendly names, doesn't it? Snapshot. Drive safe and save. DriveWise. They market it as a simple, voluntary way for you to prove you're a good driver and earn a discount. They'll send you a little plug-in device for your car, or have you download an app on your phone. It silently watches you, and in return you get rewarded for your good behavior. Sounds like a win-win. A fair deal. But it's not. It's a Trojan horse. Think about it from their perspective. For decades, insurance companies have been playing a guessing game. They use blunt instruments, your age, your zip code, your credit score, your driving record, to predict how likely you are to crash. It's a system of averages. But what if they could stop guessing? What if they could have a tiny spy riding shotgun with every single customer 24/7, reporting back on every single move you make? That's the dream. That's telematics. The discount isn't the point. The discount is the bait. The real prize for them is the data. Your data. They want to know exactly how you drive, not just when you get a ticket. They want to know if you brake hard, if you accelerate quickly, if you take corners too fast. They want to know what time of day you're on the road. And most importantly, they want to know if you're touching your phone while you drive. They are building a digital profile on you that is 1,000,000 times more detailed than a simple driving record. And here's the kicker. While they promise you an upfront discount just for signing up, they have total control over whether you keep it, or if your rate actually goes up because of what they find. They've turned your own car into a performance review, and they are the sole judge and jury. Most people fall right into this trap. They sign up, they drive like they normally do, which for most of us includes the occasional hard stop in traffic, or speeding up to merge onto the freeway, or driving home late from a friend's house, and they end up with a measly 5% discount, or worse, a notice that their rates are being reevaluated. They gave the company all this personal data for practically nothing. But we're not going to do that. We are going to flip the script. We're going to use their own system against them to lock in the absolute maximum discount they offer. We're talking 30, sometimes even 40%. And we're going to do it by understanding the game better than they do. Here's the secret they don't want you to know. The most critical period for these programs is the initial monitoring window. This is usually the first 30 to 90 days. During this time, their algorithm is building its baseline profile of you. It's deciding if you're a safe driver or a risky one. Your performance during this window has a massive, outsized impact on the discount you lock in for the entire life of your policy. After that initial period, the stakes are much lower. So, our strategy is simple. We are not going to be a good driver for the rest of our lives according to their rules. We are going to be a perfect driver, a robotically, unbelievably, almost comically perfect driver for 90 days. We are going to give their algorithm the most flawless, boring, predictable data it has ever seen. So, how do we do it? We focus on the 5 things their spies are trained to look for. First, heartbreaking. This is the big one. To the algorithm, a hard break means you weren't paying attention, you were following too closely, and you almost caused an accident. It's a massive red flag. For the next 90 days, you will become the world champion of gradual stops. You need to leave 3 no for car lengths between you and the car in front of you at all times. I don't care if people cut in front of you. Let them. You are playing a different game. When you see a red light a quarter mile away, your foot should immediately come off the gas. Coast. Let the car slow itself down. Pretend your brake pedal is a delicate, antique button, and you have to press it with the gentle touch of a feather. Your goal is to make every stop so smooth that a full glass of water on your dashboard wouldn't spill a single drop. Second, rapid acceleration. This is the flip side of hard braking. Stomping on the gas pedal tells the algorithm you're aggressive, impatient, and a potential street racer. So, for 90 days, you are going to accelerate like you're driving a priceless 100-year-old car made of glass. When the light turns green, you do not jump. You apply gentle, steady pressure to the accelerator. Imagine there's an egg underneath the pedal, and you don't want to crack it. Let other cars fly past you. It doesn't matter. Your mission is to be the slowest, most serene car off the line every single time. You are giving the algorithm a portrait of a driver who is calm, collected, and in absolutely no hurry to get anywhere. Third, late-night driving. This is a silent killer for your insurance score. The data shows that the most fatal accidents happen between the hours of 11 p.m. and 4 a.m. To an insurance company, anyone driving during these hours is automatically a higher risk, regardless of how well they drive. So, for your 90-day trial period, you need to become a pumpkin. After 11 p.m., your car does not move. It stays in the driveway. Park it. Done. If you absolutely, positively have to drive during this time, you need to understand it will count against you, so your performance on all the other metrics has to be even more flawless to compensate. But the best strategy? Just don't do it. For 3 months, become a morning person. Fourth, and this is the most important one in the modern era, phone usage. The apps are incredibly sophisticated. They use your phone's accelerometer and gyroscope to know if you're picking it up, tapping the screen, or swiping. They know if you're texting, even if the car isn't moving. This is a zero-tolerance issue for them. Touching your phone while driving is the #1 sign of a distracted, high-risk driver. So the solution is brutally simple. When you get in the car, your phone goes into the glove compartment. Not in the cup holder. Not on the passenger seat. In the glove compartment on silent, and you do not touch it until you have parked and turned the engine off. If you need navigation, set it up before you start driving and don't touch it again. If you can't resist the temptation, turn the phone off completely. A single text message can erase a week of perfect driving in the eyes of the algorithm. Do not give them that excuse. And fifth, cornering. It's a smaller one, but it still matters. Taking a turn too quickly suggests you're losing control or driving recklessly. So you're going to take every corner like you're chauffeuring the president. Slow down before you enter the turn, coast through the apex, and only accelerate gently once the wheel is straight again. Nos que tires. No G-forces. Just smooth, deliberate, boring turns. For 90 days, you will be the most annoying, overly cautious driver on the road. Other people will get frustrated with you. They will tailgate you. They will honk at you. And you will let them. Because you know something they don't. You're not just driving to the grocery store. You are conducting a masterclass in data manipulation. You are feeding a corporate algorithm, a perfectly curated set of data designed for one purpose: to unlock the maximum possible discount. And then one day you'll get the email. Congratulations! Based on your excellent driving habits, you've earned a 32% discount on your auto insurance. And in that moment, all the slow starts, the gentle stops, and the early nights will be worth it. You just saved yourself hundreds, maybe even thousands of dollars a year by beating them at their own game. You use their surveillance system to your advantage. Once that discount is locked in, you can often remove the device or delete the app. Check your insurer's policy, but most apply the discount based on that initial trial. You've passed the test. Now, this isn't a license to drive recklessly. You should always drive safely for your own sake, and for the sake of others on the road. This is about understanding and winning a very specific, very artificial game that insurance companies have created. But locking in this telematics discount is only half the battle. What if I told you there's a whole universe of other discounts most people never even know to ask for? Discounts for your job, for your home security system, even for having good grades 10 years ago. In the next part, we're going to pull back the curtain on the secret menu of insurance discounts and stack them so high, your agent won't know what hit them. Alright, let's get tactical. This isn't just about asking for a discount. This is about conducting an intelligence operation on your own life to uncover every single price-slashing advantage you're entitled to. Most people leave hundreds, sometimes over $1,000 a year on the table because they don't know the right questions to ask. They accept the first quote. We're not going to do that. We're going to build a case so compelling, so airtight, that the insurance company has no choice but to give you their absolute best rate. First, we start with the heavy hitters, the foundational discounts that are so common people forget to check if they're getting the maximum benefit. I'm talking about the big three: bundling, multi-car, and safe driver status. Everyone knows about bundling your home or renter's insurance with your auto policy. It's the first thing every agent pushes. But here's the inside scoop. The size of that discount can vary wildly, from a measly 5% to a whopping 25%. The reason it works is simple. Insurance companies see a homeowner who bundles as a more stable, lower-risk client. You're less likely to move, less likely to miss a payment, and you're giving them more of your business, which they love. But here's the pro tip. Never assume the bundle is cheaper. Get a standalone auto quote from that same company and from their competitors. Sometimes a competitor's rock-bottom auto rate, even without a bundle, can beat the bundled price from your current provider. The bundle is a power move, but you have to verify it. Next, the multi-car discount. Again, seems obvious. You have 2 or more cars, you get a discount. But did you know that the definition of your car can be flexible? If you have a college kid who lives away from home for most of the year but keeps their car registered at your address, that can often count. If you have a classic car you only drive on weekends, that can be the second car on your policy, often at a massive discount itself, which then triggers the multi-car discount for your daily driver. You need to list every single vehicle garaged at your address and ask, how can we structure this for the maximum multi-car benefit? And then there's the crown jewel, the safe driver discount, sometimes called the good driver or accident-free discount. This is where the real money is. A clean record for 3 to 5 years can slash your premium by 20, 30, even 40%. But here's the secret. Every company defines safe driver differently. For some, a single speeding ticket can reset the clock. For others, minor infractions don't count. Some companies will even forgive your first at-fault accident if you've been with them for a certain number of years. You need to ask for the exact written policy. Ask, what is your specific definition of a good driver? And how many years of a clean record do I need for your top-tier discount? Don't just accept you have the discount. Find out if you have the best version of it. Okay, that's the foundation. Now we move into phase 2, the who you are discounts. This is where we leverage your life, your career, and your affiliations. Insurance is a game of statistics. Companies group people together, and if your group has statistically fewer claims, you pay less. It's your job to make sure you're in every favorable group possible. Let's start with your job. Are you a teacher, a scientist, an engineer, a police officer, a firefighter, or a nurse? These professions are often considered lower risk, and there are specific discounts for them. But it goes deeper. Are you a member of a federal government agency? There's a discount for that. Are you active duty or retired military? That's one of the biggest discounts available, and you've earned it. You need to go down the list of every job you and your spouse have and specifically ask, do you offer an occupational discount for your profession? Don't wait for them to ask you. Next, affiliations. This is a goldmine. Think about every group you belong to. Are you a member of an alumni association from your college? Call them and ask if they have an insurance partner. Are you a member of a warehouse club like Costco or Sam's Club? They have auto insurance programs. A credit union? They almost always have a partnership. Professional organizations, fraternal orders like the Elks or Masons, even being a member of AAA. Each one of these can unlock a 5% to 15% discount. You can often stack them. Imagine getting 8% off for being a university alum and another 7% for being a member of your credit union. That's a 15% discount you got just for things you were already doing. Then there's your personal life. The good student discount is huge. If you have a driver on your policy under 25 who maintains a B average or better, that can save you up to 25%. That's not a small number. Make sure you send in that report card every semester. Are they away at a school over 100 miles away without a car? That's another massive discount, called the Student Away at School discount. And for the adults, are you married? It might not feel romantic, but telling your insurance company you tied the knot can instantly lower your rate, as married couples are statistically safer drivers. Did you recently buy a home? Even if you don't bundle with that company, just being a homeowner makes you a lower risk and can trigger a discount. Now for the third level of our operation, the How You Drive discounts. This is where technology and your habits come into play. Let's talk about the elephant in the room, telematics. This is the program where the insurance company gives you a little plug-in device for your car, or has you download an app that monitors your driving. It tracks things like hard braking, rapid acceleration, what time of day you drive, and how many miles you drive. Yes, it feels a little like Big Brother is riding shotgun. But, and this is a big but, it can also deliver a discount of up to 40%. Most companies will give you a 5 to 10% discount just for signing up. If you are a genuinely safe, low-mileage driver who avoids late-night trips, this could be the single biggest money saver you find. You have to be honest with yourself. If you have a lead foot, this could actually backfire and raise your rates with some companies. But if you drive like you're taking your grandma to church, you should absolutely be getting paid for it. Speaking of low mileage, this is a discount people constantly forget. After 2020, driving habits changed forever. Millions of people started working from home. If you used to commute 50 miles a day and now you barely drive 50 miles a week, your risk has plummeted. But your premium won't unless you tell your insurance company. You need to call them and request your annual mileage be reevaluated. The difference between driving 15,000 miles a year and 5,000 miles a year is not a small change. It's a fundamental shift in your risk profile, and your premium should reflect that. Finally, there are the discounts baked right into your car. Every modern car is a fortress of safety features, and each one is a potential discount. Anti-lock brakes, airbags, daytime running lights, electronic stability control. But the ones that really move the needle are anti-theft devices. If you have a passive alarm system that arms itself automatically, or better yet, a vehicle recovery system like LoJack, that's a significant discount. Go through your car's original window sticker or manual, make a list of every single safety and anti-theft feature, and read it to your agent. Don't assume their system automatically knows what your trim level includes. So let's put it all together. You don't just call and ask for a quote. You call with your dossier. You say, I'm bundling my homeowner's policy. I have 2 vehicles. My wife and I have been accident-free for 10 years. I'm a registered nurse and a member of the American Nurses Association. My son is on the dean's list and his school is 200 miles away. We drive less than 7,500 miles a year. My car has a factory-installed anti-theft system, and I'm willing to use your telematics app. I also want to pay my premium in full for the year. When you present a case like that, you've changed the entire dynamic. You are no longer a passive price taker. You are an informed, prepared expert on your own risk profile. You are showing them that you know the game. And that is how you don't just get a good price, you get your price, the lowest possible premium you are rightfully owed. But getting the quote is only half the battle. Next, we need to talk about the companies themselves, the giants, the underdogs, and the local heroes you've never even heard of. Because finding the right discounts is useless if you're not giving them to the right company. So let's break down the landscape of insurance companies. Think of it like a food court. You've got your massive national chains that everyone recognizes, your regional favorites that people in the know swear by, and that little independent kiosk in the corner that makes the best food you've ever had, if only you knew to look for it. Choosing the right one is a huge piece of this puzzle. Let's start with the big guys, the national giants. You know their names. You see their commercials a dozen times a day. Geico, Progressive, State Farm, Allstate. They spend billions of dollars a year to make sure their brand is the first thing that pops into your head. And there are some real advantages to going with a titan of the industry. First, technology. Their websites and mobile apps are usually slick, fast, and feature-rich. You can get a quote, file a claim, and get your proof of insurance card without ever speaking to a human being. For the digitally savvy person who values convenience above all else, this is a massive plus. Second, they have nationwide presence. If you move from California to Florida, you don't have to shop for new insurance. You just update your address. Your policy, your account, your history, it all moves with you. This provides a level of stability and predictability that can be very comforting. And because of their sheer size, they have enormous amounts of data. Their pricing algorithms are incredibly sophisticated, meaning they can sometimes offer surprisingly competitive rates, especially if you fit perfectly into one of their preferred customer profiles, a safe driver with a good record and a standard car. But there's a flip side to being a giant. When you're one of millions of customers, it's easy to feel like just a policy number. The customer service experience can be impersonal. You're often routed through a massive call center talking to someone in a different state, or even a different country, who is reading from a script. They don't know that the on-ramp by your house is a death trap at 5 p.m. They don't know about the local hailstorm last spring that everyone is still dealing with. This detachment can be frustrating, especially when you have a problem. And while their algorithms are smart, they can also be rigid. If you don't fit neatly into one of their boxes, you might find their rates are bafflingly high, with little room for negotiation or common sense adjustments. It's the fast food model. It's consistent, it's everywhere, but it's not exactly a tailored gourmet experience. This brings us to the second category, the regional champions. These are companies that might not be household names across all 50 states, but in their specific corner of the country, they are legends. Think about companies like Erie Insurance in the Mid-Atlantic and Midwest, or Amica Mutual, which is known for its legendary customer service. These companies operate on a different philosophy. Instead of trying to be everything to everyone, they focus on being the absolute best option for people in a specific geographical area. The advantage here is specialization. They have an incredibly deep understanding of the local market. They know the state laws inside and out. They know the specific risks drivers face in your region, whether it's lake-effect snow in the Great Lakes, deer collisions in Pennsylvania, or flash floods in the Southwest. This deep knowledge allows them to price their policies with a level of accuracy the national giants can't always match. Very often, this translates into better rates for you. And the service? It's frequently a night and day difference. If you look at J.D. Power's annual auto insurance satisfaction studies, you'll often see these regional players dominating the top spots, beating out the big national brands year after year. Why? Because they're smaller. They're more focused. When you call them, you're more likely to speak with someone who understands your community because they're part of it. The trade-off is that their apps might not be as flashy, and if you move out of their coverage area, you'll have to start your search all over again. But for many people, the combination of better rates and vastly superior service makes a regional champion the undeniable sweet spot. Now, let's talk about the third option, the one that most people completely overlook. This is the local hero, the independent insurance agent or broker. This isn't a company. It's a person or a small local business whose entire job is to be your personal insurance shopper. This is a game changer. Here's the critical difference. An agent from State Farm or Allstate is called a captive agent. They work for one company, and they can only sell you that one company's products. An independent agent, on the other hand, works for you. They have contracts with dozens of different insurance companies, including national giants, regional champions, and even smaller, specialized carriers you've never, ever heard of. You go to their office or call them on the phone. You tell them your story, what you drive, what your needs are. Then they do all the work. They take your information and shop it around to their entire network of carriers to find the absolute best combination of coverage and price for your specific situation. They might come back and say, okay, Progressive has a good rate, but a smaller company called Badger Mutual can give you the same coverage for $200 less per year, and they have fantastic claims service. You would have never found Badger Mutual on your own. The single most important thing to understand is this. Using an independent agent costs you nothing. It's free. Their commission is paid by the insurance company they ultimately place you with. You are getting a dedicated professional, an expert advisor, and a personal advocate for free. When you have a claim or a problem, you don't call a 1-800 number and wait on hold for 45 minutes. You call your agent, a person whose name you know, and they go to bat for you. They help you navigate the claims process and fight on your behalf. So, how do we put all of this together into a practical, foolproof strategy? It's not about picking one type and ignoring the others. It's about using them all to your advantage to guarantee you find the best deal. I call it the trifecta quote strategy. Simple, and it covers all your bases. First, you get a quote from a national giant. Go online to Progressive or Geico. It will take you 15 minutes. Fill out the forms honestly and get your number. This is your baseline. This is the price the massive, data-driven market thinks you're worth. Second, you get a quote from a regional champion. Do a quick search for best auto insurance companies in your state. Look at the J.D. Power ratings for your region. You'll quickly identify one or two of those highly rated local favorite companies. Go to their website and get a direct quote. Now you're comparing the mass market price to the specialist price. Third, and most importantly, you find a local independent agent. Search for independent insurance agent near me. Call one up. Give them the same information you gave the other two. Then let them work their magic. They will come back to you with quotes from multiple carriers, giving you a whole new set of options to compare. By the end of this process, you will have done three things. You'll have a baseline quote from a national brand. You'll have a competitive quote from a regional specialist. And you'll have a range of quotes from an expert who has shopped the market on your behalf. You are now comparing the entire landscape, not just one corner of it. This is how you ensure with absolute certainty that you are not leaving money on the table. This is how you find the hidden gems and the perfect policy for you. But getting the quotes is just the beginning. Now you have 3 different prices, maybe more, with 3 different sets of numbers and declarations pages full of jargon. What do they even mean? What's the real difference between a policy with 100/300/50 liability limits and one with 250/500/100? Is a $500 deductible really that much better than a $1,000 one? In the next part, we are going to demystify your insurance policy line by line so you can compare those quotes like an absolute pro and know exactly what you're paying for. Alright, let's pull back the curtain. You've got a stack of quotes, digital or paper, and they're all swimming with numbers and jargon. It feels like trying to read a foreign language, and the stakes couldn't be higher. One quote is $95 a month. Another is $130. The temptation is to just grab the cheapest one and call it a day. But that $95 policy might have a gaping hole in it big enough to drive a truck through. A hole that could swallow your life savings. The $130 one might be charging you for things you absolutely do not need. The price tag is the last thing you should look at. First, you have to become fluent in the language of the policy itself. Let's start with the absolute, non-negotiable core of any auto insurance policy in the United States. Liability coverage. This isn't for you. This is for the other guy. If you cause an accident, this is the part of your policy that pays for their medical bills and their car repairs. When you look at your quote, you'll see a series of numbers that look like a secret code, something like 25/50/25 or 50/100/50. This isn't gibberish. It's the most important set of numbers on the page. Let's break it down. The first number is the bodily injury liability limit per person. Let's use 25/50/25 as our example. If you cause an accident and injure one person, your insurance will pay up to $25,000 for their medical expenses. The second number is the bodily injury liability limit per accident. So, if you injure 3 people in that same accident, your policy will pay out a maximum total of $50,000 across all of them, with no single person getting more than that first number, $25,000. The third number is the property damage liability limit. This is for the other person's stuff, their car, their fence you crashed through, their mailbox. In this case, your policy would pay up to $25,000 to repair or replace their property. Now take a hard look at those numbers. $25,000. In today's world, what does that get you? A serious accident can send someone to the emergency room, require surgery, and involve weeks of rehab. Those bills can skyrocket past $100,000 in the blink of an eye. And a new car? The average price is pushing $50,000. If you cause an accident and the other driver's medical bills are $70,000, but your policy only covers $50,000, who do you think pays the remaining $20,000? You do. They can sue you. They can go after your savings, your investments, even put a lien on your house. Suddenly, saving $20 a month by choosing the state minimum coverage seems like a catastrophic financial decision. This is why many financial experts recommend liability limits of at least 100/300/100. It might raise your premium slightly, but it buys you a fortress of financial protection. Okay, so liability covers them. What covers you? This is where the next 2 major lines on your policy come in. Collision and comprehensive. Collision is exactly what it sounds like. It pays to repair or replace your car if you collide with something else, whether it's another vehicle, a tree, a guardrail, or a pothole that swallows your front tire. It doesn't matter who was at fault. If your car is damaged in a collision, this is your coverage. Comprehensive, on the other hand, is for almost everything else. Think of it as acts of God or weird stuff coverage. A tree branch falls on your car during a storm. A deer decides to play chicken with you on a country road. Your car gets stolen. It's vandalized. A hailstorm makes it look like a golf ball. All of that is covered by comprehensive. Now, with both collision and comprehensive, you'll see another key term, the deductible. This is the answer to the question we ended the last part with. A deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a dime. Let's say you have a $1,000 deductible for your collision coverage. You get into a fender bender and the repair bill is $4,000. You pay the first $1,000, and your insurance company pays the remaining $3,000. So, is a $500 deductible better than a $1,000 one? It depends entirely on your financial situation. A lower deductible, say $500, means you pay less out of pocket if you have a claim. That's great, but it also means your monthly or semi-annual premium will be higher, because the insurance company is taking on more risk. A higher deductible, like $1,000 or $1,500, will lower your premium. You're telling the insurance company, "Hey, I'm willing to take on more of the initial risk, so give me a better price." The right choice for you comes down to a simple question. Do you have $500, $1,000, or $1,500 readily available in an emergency fund that you could use for a car repair tomorrow without breaking a sweat? If you do, a higher deductible is a fantastic way to save money on your premium. If you don't, a lower deductible might be worth the higher monthly cost for the peace of mind. Now we get to the coverages people often skip, and it's a huge mistake. Uninsured and underinsured motorist coverage. You can be the safest driver in the world with the best liability coverage money can buy, but it means nothing if the person who hits you has no insurance or has that cheap state minimum policy we just talked about. Statistics show that 1 in 8 drivers on the road in the US is uninsured. 1 in 8. That's terrifying. If one of them hits you and you're injured, uninsured motorist bodily injury coverage steps in and acts like the at-fault driver's insurance. It pays for your medical bills, your lost wages, your pain and suffering. Underinsured motorist coverage does the same thing if the other driver has insurance, but not enough to cover your bills. This coverage is your shield against irresponsible drivers. It is, in my opinion, absolutely essential and often surprisingly affordable to add. Don't skip it. Finally, we have the add-ons, the smaller optional coverages. You'll see things like medical payments or MedPay and personal injury protection or PIP. These are designed to pay for your and your passenger's medical expenses after an accident, regardless of who is at fault. They provide immediate coverage without waiting for a fault determination. PIP is generally more comprehensive and is required in no-fault states. Then you have rental reimbursement. If your car is in the shop for a week after a covered claim, this coverage pays for a rental car so you can still get to work and live your life. It's usually just a few extra dollars a month. To decide if you need it, ask yourself, if my car was gone for 2 weeks, would I have another way to get around? Or would I be completely stuck? If you'd be stuck, it's worth every penny. Same goes for roadside assistance. If you don't already have it through AAA or your credit card, adding it to your policy for a few bucks can save you from a $100 towing bill down the line. So let's put it all together. When you look at those quotes now, you're not just seeing a price. You're seeing a blueprint of your financial safety. You can look at 2 policies side by side and truly compare them. Policy A is cheaper, but it only has state minimum liability and no uninsured motorist coverage. Policy B costs $30 more a month, but it has robust 100/300/100 liability limits, a deductible you know you can afford, and it protects you from the 1 in 8 drivers who are breaking the law. You're no longer guessing. You're making an informed, powerful decision. You can now read the language of insurance. But reading it is only the first step. The next step is learning how to change it. How to take a standard quote and mold it to your exact needs. All while uncovering discounts the insurance companies don't exactly advertise on a billboard. Now that you understand what all these moving parts do, you have the power to adjust them. And that's where the real savings begin. In the next part, we're going to dive into the secret discounts, the hidden levers, and the simple questions you can ask that will force the insurance algorithm to see you as a lower risk, slashing your premium without sacrificing a single drop of the crucial coverage you just learned how to identify. You've learned the rules of the game. Next, you'll learn how to win it. Winning the game starts by understanding your opponent. And your opponent is not a person sitting in a cubicle. It's not a friendly agent in a polo shirt. Your opponent is an algorithm. A cold, calculating, and deeply complex piece of software that has one job: to predict the future. Specifically, to predict how likely you are to cost the insurance company money. Every single piece of information you provide is a data point that feeds this prediction. Your job is to feed it the right data. And the most powerful data point, the one that can swing your premium by hundreds, even thousands of dollars a year, is a number most people don't even know insurance companies are looking at. I'm not talking about your driving record. I'm talking about your credit score. Now, you might be thinking, what on earth does my Visa bill have to do with my driving? Feels unfair. Feels unrelated. And yet, to an insurance algorithm, it is the holy grail of predictive data. Decades of actuarial tables and statistical analysis have shown a shockingly strong correlation. People with lower credit scores, on average, file more claims. Not just more expensive claims, but more claims, period. It doesn't matter if you have a perfect driving record. A low credit score screams high risk to the algorithm. In every state except California, Hawaii, Massachusetts, and Michigan, your credit-based insurance score is a massive rating factor. Improving this score is the single most effective thing you can do to lower your auto insurance costs over the long term. So how do you do it? First, pull your credit reports from all three bureaus, Equifax, Experian, and TransUnion. You can do this for free once a year. Go through them with a fine-tooth comb and dispute every single error, no matter how small. A misspelled name, an old address, an account you don't recognize. These errors can drag your score down. Second, focus on your credit utilization ratio. This is the percentage of your available credit that you're currently using. If you have a credit card with a $10,000 limit and a $5,000 balance, your utilization is 50%. The algorithm hates this. Aim to get all your cards below 30% utilization, and ideally below 10%. Pay down balances or even call your credit card company and ask for a limit increase. This instantly lowers your utilization percentage without you spending a dime. Third, pay every single bill on time. Payment history is the biggest component of your score. Set up autopay for everything. One late payment can linger on your report for 7 years. By cleaning up your report, lowering your utilization, and maintaining a perfect payment history, you are fundamentally changing the story your data tells the insurance algorithm. You're transforming from a high-risk gamble into a safe bet. The next secret weapon in your arsenal is understanding the power of your address. Insurers use your zip code to determine risk based on a huge number of factors: the rate of theft and vandalism in your area, the frequency of accidents, the cost of car repairs, and even the weather patterns. Moving a few blocks can literally change your premium by 20%. Now, most of us can't just move to get cheaper insurance. But what you can do is be precise. Do you park your car in a secured garage every night? That is a critical piece of information. It tells the algorithm that your car is protected from theft, vandalism, and even hail. It's a different risk profile than a car parked on the street. Make sure your insurer knows this. Some people have a P.O. box or a mailing address that's different from where the car is physically kept overnight. The garaging address. You must be honest here, but ensure you're using the correct, specific address where the car is actually parked, as it could make a real difference. Now let's talk about discounts. Most people know about the basics like good student discounts or having anti-lock brakes. That's beginner-level stuff. We're here to win the game. You need to dig deeper. You need to become a discount hunter. Start by thinking about your identity and affiliations. Are you a member of a professional organization like a teachers' union, an engineering society, or a bar association? Are you an active or retired member of the military, a federal employee, a member of an alumni association, a fraternity, a sorority, or even a credit union? All of these groups often have partnership agreements with insurance carriers that unlock affiliation discounts most people never think to ask for. Go through your wallet and your resume. Every group you belong to is a potential discount. Next, think about your car itself. Does it have an anti-theft system? Not just a standard car alarm, but a passive immobilizer or a GPS tracking system like LoJack. These are major discounts. Did you know that simply having daytime running lights can get you a small discount with some carriers? It's all about reducing the statistical risk. Then there's your behavior. Completing an approved defensive driving course can knock 5% to 10% off your premium for 3 years. The cost of the course, often less than $50 online, can pay for itself in the first few months. This is a no-brainer. And here's one almost nobody knows about: the paid-in-full discount. Insurance companies spend a fortune on billing and processing monthly payments. If you can afford to pay your entire 6-month or 1-year premium up front, they will often give you a significant discount, sometimes as much as 10%. You save money, and they reduce their administrative overhead. It's a win-win. You also need to be strategic about what is called bundling, or the multi-policy discount. The commercials make it sound simple. Bundle your home and auto insurance and save a ton of money. And often you can, but you have to be careful. Bundling is also a psychological tool designed to make you a sticky customer, one who is less likely to shop around because it feels like too much hassle to move multiple policies. The smart shopper always does the math. Get a quote for the bundle, absolutely. But also get standalone quotes for your auto insurance from other companies, and a standalone quote for your home or renter's insurance from others. Sometimes, two separate policies from two different, more competitive companies are actually cheaper than one company's discounted bundle. The only way to know is to run the numbers. Never assume the bundle is the best deal. Verify it. Finally, let's address the elephant in the room: telematics. These are the usage-based insurance programs like Progressive Snapshot or Allstate's DriveWise, where you either plug a small device into your car or use a smartphone app to track your driving habits. The promise is huge. Prove you're a safe driver and get a massive discount. The reality is complicated. These programs track everything: how many miles you drive, what time of day you drive, and most importantly, your driving style. They are looking for hard-braking events, rapid acceleration, and high speeds. If you're a textbook perfect driver who rarely drives late at night, you could save a lot of money. But if you live in a city where sudden stops are a daily necessity, or if you occasionally have a lead foot, this device can backfire spectacularly and actually increase your premium upon renewal. It is a Trojan horse. You are voluntarily giving an insurance company a fire hose of data to use against you. My advice is to be extremely cautious. Only consider it if you are supremely confident in your driving habits, and even then, understand that you're trading your privacy for a potential discount that is not guaranteed. You've now fortified your position. You've polished your credit, armed yourself with every possible discount, and understood the risks and rewards of modern insurance tools. You've turned yourself from an average applicant into the algorithm's ideal customer. You are finally ready to go out and get quotes. But how you get those quotes is just as important as all the prep work you've just done. There is a right way and a wrong way to shop for insurance, and the difference can save you from a world of spam calls and ensure you're comparing apples to apples. You now have all the ammunition you need to get the lowest possible quotes. But getting a quote is not the same as closing the deal. In the final step, I'll show you the exact phrases to use with an agent and the one question you must ask that can save you an extra 15% at the very last second, after they've already given you their final price. Alright, you've done the hard work. You've gathered your quotes, you've compared them apples to apples, and you've identified your top contender. Now it's time to pick up the phone. This is where the real savings happen. This isn't about being aggressive or confrontational. It's about being prepared, polite, and firm. You are the customer. You hold the power. When you call the agent, whether it's at a big company or a small local office, have your preferred quote in hand. Your opening line is critical. Don't just say, "I'm calling about a quote." Instead, say this: "Hi, my name is," your name, "and I have a quote here, reference number." Give them the number. "I'm looking to make a final decision and get my new policy started today, but I had a couple of quick questions to make sure I'm getting the absolute best value possible." Let's break down why that phrase is so powerful. First, you've given them your name and reference number, which shows you're organized. Second, you've created a sense of urgency and commitment by saying, "I'm looking to make a final decision today." This tells the agent you are a serious buyer, not just a window shopper, and they are much more likely to invest their time and effort into helping you. Third, you framed it as getting the best value, not just the cheapest price. This signals that you're a smart consumer, and it opens the door for a collaborative conversation rather than a battle over pennies. Now the agent pulls up your quote. Your first move is to ask them to walk you through it one more time. Say, "Could we just quickly review the coverages and discounts together? I want to be 100% certain everything we discussed has been applied correctly." This is a non-threatening way to double-check their work. You'd be shocked how often a discount is missed or a coverage amount is entered incorrectly. As they go down the list: multi-policy discount, good driver discount, paperless billing, anti-theft device, you tick them off your own checklist. If they miss one, you can politely say, "Oh, I thought we also discussed the discount for paying the policy in full. Is that reflected in this price?" This is your chance to catch any errors and potentially lower the price before the real negotiation even begins. Now let's assume the quote is correct and all the initial discounts are there. It's time to introduce your leverage, the competing offer. This is the most important part of the call, and the wording is everything. You do not want to say, "Hey, Geico offered me $100 less, can you match it?" That sounds demanding and can put an agent on the defensive. Instead, you use a technique I call reluctant loyalty. It sounds like this: "Thank you for confirming all of that. The policy looks great. The only thing giving me pause is that I do have a very similar offer from competitor's name. Their price is..." Mention the competing price, for example, $750 for 6 months. "Honestly, I would much prefer to be insured with you guys. I've heard great things about your claim service, but as you can understand, a price difference of mention the dollar difference is hard to ignore. Is there anything at all you can do on your end to help bridge that gap for me?" Let's analyze that masterpiece. You complimented them. You gave a specific, believable competing offer. You provided a logical reason why you want to choose them over the competition, in this case their claim service. This makes the agent your ally. They now want to find a way to keep you. You've turned it from a confrontation into a shared problem to solve. You're not demanding, you're asking for help. This is the single most effective way to get an agent to dig deeper for you. They'll likely put you on a brief hold. They're going to check for any other possible discounts, maybe a loyalty program for new customers or a specific affiliation discount you might have missed. When they come back, they will almost always have a better offer. It might not match the competitor exactly, but it will be closer. Let's say they come back and say, "Okay, I was able to apply an additional defensive driver discount, and that brings your new total to a lower price." This is fantastic. But we are not done. We have one more card to play. This is the question I promised you. The one you ask after they've given you their absolute final rock bottom price. After they present their revised better offer, you say this: "That's fantastic, thank you so much for doing that. That makes the decision much easier. I really appreciate you working with me on this. Before I give you my payment information to lock this in, I have to ask one last question. I've read that sometimes before a policy is finalized, there's a final underwriting review or a new business check that can sometimes uncover additional savings, especially for a new customer with a clean driving record. Is there any final check like that you can run on your end before we make it official?" This question is pure gold. It's polite, it shows you've done your research, and it gives the agent a specific, professional-sounding action to take. You're not just asking, "Can you do better?" You are giving them a plausible reason to look one more time. It gives them an out to check with a supervisor or look in a different part of their system they might not typically use. It's the agent's last chance to earn your business, and this question gives them the perfect excuse to find that last little bit of savings, which could easily be another 5, 10, or even 15%. Once they come back with that final number, and you're happy with it, it's time to close the deal. Confirm the policy start date. It should be the exact same day your old policy expires. Do not leave a gap, not even for one day. A lapse in coverage is a massive red flag and will skyrocket your rates in the future. Pay for the policy right there on the phone. Most companies offer a significant discount for paying the full 6-month or 12-month premium upfront. If you can afford to do it, you should. While you are still on the phone with the agent, ask them to immediately email you your proof of insurance cards and the policy declaration pages. Do not hang up until that email is in your inbox. Open the attachments and verify that your name, your vehicle, and the policy dates are all correct. Only after you have the new policy documents in your hand, confirmed and active, should you call your old insurance company to cancel. When you call them, they will likely try to win you back. They'll ask what the new company offered you and may try to match it. You can entertain their offer, but remember they had the chance to give you their best price all along and didn't. Stick to your guns. Tell them you've already made your decision and paid for the new policy. Make sure you get a confirmation of cancellation in writing or via email. And that's it. That is the complete blueprint. From understanding your needs to decoding the jargon, finding every discount, leveraging online tools and local agents, and finally negotiating like a pro to lock in the absolute best rate. You just completed a masterclass in auto insurance. You now know more than 99% of drivers on the road. This process we've walked through isn't just about saving a few $100s a year, though that's a huge part of it. It's about taking control. It's about transforming something that feels confusing and overwhelming into a simple, repeatable system. It's about knowing you're not just another number. You're an educated consumer who is getting the right protection for your family at a price you deserve. So don't just watch this video. Use it. Pull out your current insurance bill right now. The next time your renewal comes up, don't just blindly pay it. Follow these steps. Put in the work. I promise you, the feeling of seeing that new lower premium, knowing you earned it through your own effort and knowledge, is incredibly empowering. You have the tools. You have the playbook. Now go out there and claim the savings that are rightfully yours. Stop overpaying. Start driving smarter. The power is in your hands.